right, for most of the day, stocks were on par for just a really quiet day and an easy kind of neutral close until the very, very end. And we had a pretty bad close, I think, as people were going into the weekend, not wanting to be as long. A very, very important week next week with the FOMC and the CPI reports coming out all the way around. But CPI on Tuesday and FOMC on Wednesday. I'm going to describe to you the technical situation, the environment we're going into those reports. Of course, anything can happen coming out of those, but based off the environment going into it, we can anticipate what's going to happen. So I'm going to break down all the different indicators, and I'm going to give you a picture of what we look like going into next week. And then we're going to take a look at what's driving. Like there was a pretty classic pattern today. So I'm going to describe to you what that class, or not just today, this week. I'm going to describe to you what that pattern was and just how classic it was and the significance that has for us going into next week as well. And then our trade ID is a stock that really kind of had a bearish pattern, pretty similar to some other trades we've done here recently. So I'm going to show you, what that pattern is and how to trade it, and what kind of trade we can set up for. Pretty aggressive trade this time. So let's go ahead and get started. Today is Friday, December the 9th, 2022. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel with this icon here in the bottom right corner of your screen, or the subscribe button down below. Hit the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos from day to day, and join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, you can check out some of these other things here on the right, including our Market Outlook live video. If you come down here to the bottom, click that heart. It opens up this tab. Hit that like button. Same thing here. Click the thumbs up icon. It opens up a new tab. Hit that like button. Again, we really appreciate those who do that. It actually really helps us get our content out to all of our followers on those social media platforms. That's why we always ask for it every video. All right, let's start off taking a look at the S&P 500 here with the market forecast indicator. As you can see, we had 6 out of 7 down days now, with the one day being that Thursday up day coming off of the bearish short-term sentiment on Wednesday. You can see the drop closing at the low of the day on Friday brought the momentum line all the way down below the 5th percentile. Did not get us below the moving average. That's why we don't have the light pink shading and yellow line. Otherwise, we had that bull tag right now. We got it's pretty similar. I mean, this is the kind of conditions you get when you get a bull tag. We're just not quite there. We were 0.27 away on Wednesday. We were 0.06 away on Friday. So that's how close we are. Of course, the intermediate line is still falling. It's not going to drop below 50. Intermediate line is not going to drop below 50 on Monday. It could on Tuesday, depending upon how bearish Tuesday may be, if it is a bearish day after the FOMC. We've been talking a lot about these bull tags. Every one of these declines started with a bull tag, but 2 of the 3 had multiple bull tags. So we were kind of up and down briefly before. But by the time we got that last bull tag, like this day, that was the day that we just kept going from there. And same thing on that day when we got that last bull tag, we just kept going from there. And the same thing here. So it's the bull tag can be really bullish pattern if we are to trend higher, right, and continue to trend higher. But if it's not, I mean, it's again the day that breaks us through, and it tends to be a pretty decently bearish day. They've been getting progressively bigger because the market's been more progressively bearish. But if we get a day like that on Tuesday, where we break down, get a bull tag, let's say we don't get one, let's say we bounce up tomorrow, tomorrow, I wouldn't be surprised at all if we bounced up tomorrow. But then we get a day like this on Tuesday with the bull tag, I wouldn't be surprised if we just kept going from there. Again, barring what Wednesday would bring with the FOMC statement. Remember, FOMC on this month includes the press conference and statement as normal, but also the projections. And that's going to be a big topic too, a big factor in terms of how much they're going to raise rates, the terminal rate, what they think their economic projections are, whether or not they might pivot sometime in 2023 and actually start cutting rates. Pivot's a hot topic because they pivoted last time when they were raising rates from 15 to 18, more aggressively in 17 and 18. You know, they had one 25 basis point hike in 15, one in 16, and then 3 and 17 and 4 and 18. So every quarter they did one. But then they stopped in December of 18, and then they actually cut rates in August of 19. So, I mean, they pivoted. Within 9 months, they pivoted. And so the market's going to be looking to see if and when they might have the same kind of pivot here. Because remember, the yield curve inverted briefly there. It's been inverted for months now, but it inverted briefly there, and that's what kind of prompted the pivot to a rate cut. That's typically what the Fed does when there's an inverted yield curve, is they cut rates. But they've said this go around that they're not going to cut rates. They're going to leave rates higher for longer, which means we may have an inverted yield curve. Either we may have an inverted yield curve for quite a bit, or the yield curve will uninvert as long-term rates rise back up again, which we've seen that's a pretty bearish scenario. It has been a bearish scenario for equities all year. So that's what we see there on the SPX. Remember, the Dow's been more bullish. So the Dow, you can see, is broken back down below this 62% retracement level this week, and did get that bull tag on the Dow. So we finally did get a bull tag on the Dow there, closing below the moving average by 0.03%. And then the intermediate line being below 80, but still easily above 50. So light pink shading the yellow line again. And that's not really a dramatic move. So I wouldn't say it's a bull tag like this one that starts a bearish move. If anything, it's going to be, we might go up and down for a couple of days. But every one of the bull tags on the Dow started the bearish run here. And then now your NASDAQ has been on the opposite side of the spectrum. It has not got a bull tag yet. When we did drop below the moving average was actually dropping briefly. That's why it was red and not yellow. But the same concept applies. You got light pink shading here. We're right around the moving average. Again, bull tag. We did not get a bull tag here, but it's the same idea, right? Just wasn't yellow. By the time we went pink, it was red. And then we didn't get a bull tag up here either. By the time we got below the moving average, it was also red. So, you can see that's kind of the flirtation we're getting now. But though the moving average is moving up, so there's a good chance we get a bull tag this go around if we are going to start a move to the downside. That's my expectation, actually, that we will. By the end of this week coming up here, we'll probably be starting, because if you look at now the weekly version of this market forecast, so for the NASDAQ, you can see we're failing at the moving average. That's a pretty bearish weekly candle there. The intermediate near-term line coming out of bullish territory did not get strongly in the upper reversal zone. So it's a pretty bearish near-term peak. Obviously, it's a much lower peak coming off the 50% retracement and the moving average there, and already back down below the 38. That's not the case for everything. Like SPX, you can see we got above the moving average, though now the near-term line is falling to where the momentum line is taking it. We got above the 62% retracement here, and we just broke below the 62. We're still above the moving average, just barely. Your Dow Jones, which has been the most bullish, remember, got above the 100% line, is now back below. But that's a pretty bearish. I mean, you got a kind of a hanging man last week, and then now this. This is a pretty bearish candle too. Still easily above the moving average, but your momentum line dipping. So you can see how things are changing. In fact, when you look at the other weekly chart we look at here, the Hakinyashi candle is a transition candle, one that was a bearish candle. So there's a good probability that this will lead to a bearish candle this week. Again, anything can happen with headline risk, right? You got CPI and FOMC, so anything can happen with headline risk. But the technical environment is set up for a bearish week this week coming out of these headlines. So we'll see if how things set up there. A bit significant high transition candle on that. You can see the transition candle up here. That first was the last real significant. There's a little bit of a transition candle there in 4-4. So if you look at the candles there, 4-4 was a bearish week, and then that was a bearish week. So again, when you get transition candles that are bearish weeks, they tend to lead to more bearishness in the successive weeks. So that's kind of what we have going on with the weekly. We also sometimes take a look at the Hull. Here's the weekly candles for the Hull, and you can see the transition there. The MACD, the MACD is still above its moving average, so we're still got some positive momentum towards the 200-day, though it's turning back down. The histogram's turning down, and you can see we're not very far. Like, we got a lower close. You expect that, if we close below this body, which we're set up to do at the open on Monday because of this was a bearish week. So that's a bearish body. You can see though we still have quite a bit of room before we flip that parabolic SAR to the upside and we really start the trend. So it might take a week or two of transition here to start bringing these parabolic SARs up closer. Over here you're pretty decent, you had a pretty bearish week and that kind of set the table. But it's it's really when you get that flip of the parabolic SAR that things really take off to the downside. You can see it up here too. That's when it really took off to the downside, and that's kind of what you would expect to see. Let's take a look at the 3 green arrow charts. We do not have 3 green arrows on any of these charts. In fact, the Russell 2000 is showing 3 red arrows and has now for 4 straight days. So I mean, it's one thing just to show up for one day, but now we got 4 straight days of red arrows. The moving and the moving average is turned down, so you're getting a red line with those 3 red arrows now. That's pretty significant in terms of the Russell. We don't have that yet anywhere else. We never did get the we got light pink shading briefly here for like a day, but we got the green arrow again. We've had the green arrow up there, so no shading on any of these others. And then when you look at the 2-line version. For that, we have been now we haven't been below the 30-day moving average, but we have been below the 17-day and now the point of control for multiple days as that MACD is trending lower towards 0 and the stochastics is well below 0. In fact, the stochastics, as you can see, has dropped significantly into the bearish territory, and this stochastics is way down there. It is dropping below 20, easily below the moving average, well into bearish, lower half of the chart. These are bearish levels. Among other things, right? When you look at the money flow is down below 50 easily, right? That's the crossover point for bearishness on the money flow. The McClellan oscillator has been below 0, is now flirting with that minus 35 level. 35 minus 35 is my anecdotal level for when things can really start trending in a direction. So that's a pretty significant bearish move there. So these are all bearish reversals on all these indicators that suggest we are. I mean, even like the RSI and the CCI, they're flirting with that midpoint. The CCI actually is, but CCI's got to get below this minus 150 area to really solidify the move into the lower half of this chart. We have to get below 40 on the RSI to really solidify that break below the midpoint, which you're just barely getting right now. The DMI is also showing a little bit of a reversal. The negative indicator had made its way above 25. It's now kind of flirting below 25. The positive indicator is actually still holding up above it. Either way, the ADX has dropped way down. So whatever trend strength that we had, it's gone, right? So that close was that bearish on Friday that it pretty much eradicated both the trend quality and noise balance. It flipped to 0. We're still above the cloud. You're still above the blue line, but it's a very tenuous move. The issue is we need to stay above. When it flips green, we need to stay above that, because remember this crossover here is when we went bullish 26 days ago, because this is plotted forward 26 days. So if we get, by the time we get to the green shading, if we're not holding that crossover and the red line is below the price, which you can see, a week from now will be, if we don't go anywhere, if we don't go up, it will be below the price if we just go flat. You can kind of see how that 26-day rate of change flipping negative is also kind of a sign of reversal that we have coming up there. So a few things that are kind of showing up. The Bollinger Bands and the Keltner channels are also showing you. You got the red dots here. This is a sign of reversal when you flip from one momentum to the other. With a red dot. You don't have to be red dots, but typically the red dots flip you from one momentum to the other, one momentum to the other, one momentum to the other, one momentum to the other. Over here, you got your green on both this one leg and this leg. Not green on this leg. We're getting the red dots, which flips you from one momentum, in this case, to the other, which is a downward momentum. But that will happen if and when, and you can see the Bollinger Bandwidth actually dipped to its lowest level last 150 days. So it's also setting us up for a breakout move. And again, if you had to bet on which way we're going to break out, to the upside or downside, all the other patterns are suggesting is to the downside. Of course, it can. Obviously, nothing's 100%, so it can flip to the upside. And if it does, then we are set up for that famous Tom Lee rally, right? We are set up for a really good move to back to new highs, or at least the all-time highs by beginning of next year, like within a few months. So it won't take very long. But I think what's going to have to happen is the Fed's really going to have to like say, we hear you, we agree with you, we will stop raising rates, potentially setting up for this meeting to be the last one, because that's what the bond market thinks this is going to be a last rate hike, excuse me. That will stop at 4.5%. The futures market still thinks we're going to get to 5%, and there's a good chance of 5.25% by next year. But the bond market says no, 4.5% is probably all they're going to get to. So if the Fed comes out and agrees with the bond market and says okay, because usually the bond market tells the Fed what to do. If the Fed comes out and says okay, we'll do what you tell us to do, like we always have, then they'll stop, and I think the market could really take off. And now it won't be like a 2-year bullish move. It's gonna, by the end of the year, if we take off right now, by the end of 2023, we'll have a reemergence of inflation again. And again, mid to late 70s all over again. That was the danger. The issue is whether Powell can stand by what he said and actually tell the bond market what he's going to do instead of the other way around, which has been the MO for years now. There hasn't been it's been a while since Volcker where the Fed chair has told the bond market what he was going to do instead. So we'll see how much gumption Powell has. But I can see that being the catalyst for a good rally coming out of next week. I think that's the lower likely scenario because I take Powell to what he said and what he's been continuing to say since the Jackson Hole speech in August, that he's expected to raise rates till we get a positive Fed funds rate, real Fed funds rate, which we're nowhere near, and we're going to keep it there for longer like they did in the 70s to avoid the reemergence of inflation like we had in the 70s when they stopped too early, like we have the potential of doing right now. So you see what's the catalyst for the rally and in my opinion, the more likely scenario for what could catalyze the move to the downside, right, to the downside there. Let's take a look at the intraday ranges here. So you can see we closed near the low, like you can see the low really moved up. So like the range, if you look at the range, here's another indication that we are set up for a breakout move. The intraday range, the 4-week range, is really dipped down to less than 4%. It's a very small range. The low point has moved off of the last day, though unless we get a new low point Monday, which we won't, it will move a little bit closer. But we've already hit zero, and now we're below 70. So we are set up for a breakout to the upside on this, and I expect that will be. You can see how easy it is to get a new low. It's actually much harder to get a new high, so because we're further away. So you see how easy it is to get a new low, and I expect, if not by Monday, I don't expect a big move tomorrow, but I do expect Tuesday to produce that new low point coming out of that CPI report, going into the FOMC, and then that FOMC again can really either turn it completely around to the upside or can really solidify the beginnings of this new leg lower, which, again, my opinion is that next week will really solidify the move here. As you can see, we're failing at the 50-week moving average again, like solidify the move back below these moving averages, working out, MACD histogram moving back down, the MACD moving back below zero, and moving back to and through the 200-week moving average. I think ultimately on this move, working our way down towards this, either the pre-COVID high point, which is right around, for SPX, it would be right around this 33.75, 33.85, and 90 in that area. So this area here, or more likely down towards these Fibonacci areas, and these multiple long-term areas right around 3,200. I think that's the more likely scenario. So anywhere in this range is where the move to and through the 200-week moving average, and that's really the bearish move that starts the bearish trend, the bear market, right? That's what starts the bear market. This is just all correction until you get that move to and through. that starts the bear market. You'll get a little return move back up, a little bullish bounce back up, but it will, it fails, and then you get your impulse, your bear market washout type moves from then on. And I think ultimately we spend most of 2023 below that 200-week moving average there. If you take a look at the VIX, here, let's go to this one. Take a look at the VIX. The VIX rallied into the end of the week, which is not normal. Normally the VIX is closed at the low of the week, so that kind of gives you an indication like how bearish we were last week. We could reverse that, and we're back up above the 90% mark this week. When you look at the correlation with the VVIX, you're back to being positive. The VVIX had a bullish week too, back up to 87, though it's still very, very low. But now you have the correlation positive, so you have a move where the VIX is starting to work its way to the upside, right? The VIX is starting to, it's above the 17-day moving average. It's MACD's above it, it's moving, so we're starting to trend up here, like we did over here when it got above the 17 and we started to work our way higher. I think that's the type of move we're looking at now. Going into next week, we'll start to fill in that gap between the 30 and these moving averages, and then ultimately move back up above towards the 30s. I don't think we'll get there by next week, but I do think we'll move up towards the 30s over the course of this next leg lower on the S&P 500. All right, now let's take a look at what's driving the price action this week. And this was a pretty classic, here we go. This was a pretty classic risk-off week. When you look at the chart here, so let's go to December. We'll go right there. You come back out here. This is about as classic of a risk-off week as you could have. The dollar, gold, and bonds are all up, and global bonds, and corporates. High yield was above all these equities, and real estate was down. Commodities was down. You can see IWM is down 5%. I mean, risk off. That is risk off right there. With bonds, like I said, bonds up, down for the week, but above all these equity asset classes. Interestingly enough, you can see in this really risk-off week, international stocks, although down, were not down very much relative to U.S. equities. And I think that's going to be a common theme for 2023 as well. International equities will end up holding their value better because they've already experienced their bear market that U.S. stocks have not yet, because we were so bullish. We were so far above the 200-week moving average, and bear markets don't start until you get below them, right? So they've already been below and experienced a good chunk of their bear markets, and U.S. equities haven't. So I think this is going to be a common pattern that we'll see throughout much of next year. If you look at the sector, same thing with the sector comparison, you also had, again, a classic risk-off move. If you go to December, then we'll go here and we'll go to like the 15 minutes again. You can see XLE was down. Energy has been the big winner all year long, right? So they're down 8.5% this week. Technology to communication services, discretionary communication services down. Financials, industrials, you can see technologies up there too. Materials is up there. I mean, these are your cyclical areas in both sides, right? Your cyclical and your long duration all falling pretty significantly. The only things really holding up are utilities, staples, healthcare, real estate, your safe haven areas. Like they were all down too, but not down nearly as much as the rest of the market. And that's, again, very classic risk off. This was a classic risk off week this week, about as classic as you could possibly get. Let's take a look at some of the charts for these different asset classes. Let's start off with bonds, and you can see bonds really rolled over the last couple of days. Long-term bonds here, that they've been so overbought. They got above that 23% retracement level this week, and then finished the week back down below it. So again, this falling, it was really late that it fell. It was still up for the week, or barely down for the week, as you saw. There's where it finished last week, 107.09. So barely down for the week, and was up for most of the week. But you remember, falling bonds have actually been bearish. I mean, bonds and stocks have been going down together as yields start to work their way back up. And I expect that yields will, we're at 3.56%. Remember, the Fed's going to be at 4. The Fed funds will be at 4.5% on Wednesday. So if we're going to have any kind of uninverted yield curve between the Fed funds rate and the 10-year yield, the 10-year yield's got a lot of room to go up. It's very oversold from a technical analysis standpoint. So there's an opportunity here for there to be a significant rise in yields, which, again, for most of this year has been a really bearish thing for equities. Commodities has been something, too, that's been on the radar. You can see it's been really bearish here. Obviously, the 8 and 17 day have crossed below the 30 and the 50. The 30 is about to cross below the 50. All these moving averages are below the point of control. They're all below the 200-day moving average. There's no volume in the last year, very, very little volume below where we're at right now. All this year's volume, 70% of it, is above where we're at right now. If you look at the weekly chart, it even looks worse, right? It looks like we are starting to correct on commodities. And this is one of the most bearish weeks we've had here, especially considering it's below these moving averages. So, you see the gap in volume all the way down to the 200-week moving average, actually a little bit below it. You've got a good chance here, probabilities that commodities will break down and start to correct. And again, commodities don't correct in bull markets. Commodities correct in bear markets. We are set up for a significant correction in commodities, which would reflect a dramatic reduction in demand, which will obviously put some pressure on equities. Again, commodities, out of all the intermarket relationships, this is the last one to fall, right? Currencies fall, bonds fall, stocks then fall, then commodities fall last. Because they rise during the inflationary period, which is the very tail end of a bull market. Stocks start to roll over during that inflationary period as we get to that inverted yield curve with the Fed raising rates. Commodities still go up after stocks peak because we're still in that inflationary period. Stocks start to fall by the time we end the inflationary period and transition to deflation. Stocks are already falling, but commodities are still rising, and then commodities fall last as the Fed starts cutting rates because there's decreasing demand, and they have to, and so commodities fall. So that's what we're seeing, right? We're seeing the commodities here really breaking down this week. So if we're not going to correct, then we really need to reverse this pretty quickly. And I don't think that that's necessarily going to be the case. It's good. The good sign is that's the Fed's goal, right? The Fed's goal is to kill inflation. They have to kill demand to do that, to bring it back down to where these low supply levels are, which supply levels are still very low. So they have to bring demand all the way down to these low levels, or the federal government's got to help the economy bring supply up to where the demand levels are, and that's not happening. So it's going to be this way, and again, that's what the Fed's been shooting for, and it appears now that they're going to finally start getting it as commodities continue to fall to the downside there. All right, the trade that we talked about today in our Market Outlook Live video that we did at 3:30 Eastern Time on Friday before the market closed. I actually did a little bit early on Friday this week. But this is the trade that we discussed in that particular video, is on Amgen. Let's take a look at Amgen here. So give me 1 second. Here, whoops, not this chart. I keep hitting the wrong one there. So let's go to this one. All right, Amgen, as you can see, has got a bull tag, right? And a pretty significant day, too. That's a pretty bearish day there. Probably not the kind of day that you would rally up to the upside. And part of the reason why is because not only do we break the 30, right, which obviously that's what creates the tag, is when you break that 30-day moving average. But we also broke below the 8 and the 17 as well. And we were so bullish here in October, November, and there's a gap that we're filling in right now, that there's a huge gap in volume here. So very easy to fall at least to the 50-day moving average, if not through that, back down towards these old highs, right, down to 250, because there's just literally no volume here to hold it up as we've been converging for so long and finally breaking down, and the stochastics have been trending down, is in bearish territory again. So, we are set up for a bearish move on the stock. You can see its CCI broke to minus 200. Its RSI broke into the lower half of the chart. That's a pretty bearish break on that CCI to really, you would expect that it will really solidify the bearish move to the downside. The positive indicator here has dipped below 25 and was working its way below 20. The negative hasn't, we were so bullish, the negative hasn't jumped up yet, so it's still barely above 20. But still, it's about to cross over there with the ADX already above 20 itself and still actually a little bit above 25. When you look at the Ichimoku cloud for Amgen, we're way above the cloud. We have an extremely strong trend going, but you look at that red line and look how close we are to a 26-day crossover on the rate of change, or crossover, excuse me, on the 26-day rate of change. And you can see it, some of these other charts like the Bollinger Bands and the Keltner channels. I told you about those red dots that lead from one momentum to the other. Well, that's, I mean, the bandwidth is about as low. I mean, after it has such a huge bandwidth, that got us up to a new 150-day high point for the bandwidth. Way big bullish move. We've, in just a short amount of time, we've really converged back to where the bandwidth is already back down to the 150-day low, just like that. And we're in the lowest quartile now. Big break today gets to the lowest quartile, and we're set up for a break outside of the bands. We can get a pretty significant break outside the bands here and still be inside the Keltner channels, and that's when there's such a big gap there. That's when you're the most susceptible to a squeeze play. So that's kind of the trade I'm actually expecting to get. If you look at the we didn't look at the weekly chart here for Amgen. You can see the multiple weeks of transition candles. Last week, though, was not a bearish week. This week has been. So this is the transition week. This is the week that I expect that transition week will lead to a bearish reversal now next week, especially with the PPO pretty much at the highest level for most of this past year, or last couple of years, excuse me. If you go back actually 5 years, you can see that just that one brief move there at the end of 19, beginning of 20, before COVID, there was the PPO higher. So I mean, it's actually a pretty significantly high PPO right now, and I think it's probably too high as we move back down towards this 255 level. So what I did is I went out to the January expiration, which is in the 20 to 50 day window, and I was pretty aggressive. I bought, out of the money near the 20 deltas and sold a little bit further out. Remember, 255 is where those old highs are, so that sets us up for a 5 to 1 reward to risk ratio here with excuse me, with the stock already down since we got into the trade at the end of the day, or from more the middle of the day Friday. It's already down a little bit more, and then you can see how much room I have to work with in terms of getting that maximum gain inside of just one standard deviation, much less potentially two if things really start to break out to the downside on the Amgen. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link that's popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up a new thread there with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going among you all that are watching the video from day to day. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on the video, like us on Twitter and Facebook as well. Join our website at marketscholars.com for free. Have a great rest of your weekend, everybody, and we'll see you all on Monday.